All right, everyone. So we are back for our next session that starts right now with Patrick Ceresna. This presentation will be about the application of what we learned earlier today, and we will be discussing about trading options. So today we're very lucky to have on board with us Patrick Ceresna. Patrick is the founder, chief derivatives market strategist at Big Picture Trading. Um, Patrick is a chartered market technician, derivative market specialist, and also Canadian investment manager by designation. Patrick is an instructor on derivatives for the TMX Montreal Exchange, educating investor and investment professional across Canada about many valuable uses of options in their investment portfolios. Patrick is also the co-host of Macro Voices weekly podcast and the Market Huddle YouTube show. He also specializes in analyzing the global macro market condition and translating them into actionable investment and trading opportunities. So today, Patrick will review and demonstrate how to buy option and the process for selecting strike prices and expirations. He will then explain and demonstrate how to execute a bull call and a bear put debit spread to offset volatility risk and how to hedge an equity position using option collar on stock you already own. So Patrick, the floor is yours. Have a great presentation.
Well, thanks, JP, and hello, everyone, and thanks for joining us. I'm really excited to take you all through this session. Normally, I have a whole PowerPoint presentation that I do, but I get the opportunity that we're doing an options education day with the live markets open right now, and they let me loose, and they basically said, let's get into the live markets and actually take a look at the real prices and actually take everyone through a journey rather than just watching PowerPoint. So I'm really excited. We're going to be able to look at all sorts of fun stuff. So just very quickly, and by the way, yeah, just a disclaimer for this is more important than usual. I'm demonstrating things in the live market, but this is not advice. All right, and so we're going to be utilizing the TMX Trading Simulator, which is free on the Montreal Exchange website. I will show all of you where you can find this, and we're going to actually be placing in simulated trades from the live markets and a lot of the really neat things that we can do. And our goal in this session is really first to just take a look at some live options chains, look at where are the different strike prices, where are the different what are the in the money and out of the money options, and how we put this all together. And then what we do is we're going to look at the application of debit spreads, and particularly I felt debit spreads are pretty important to actually demonstrate how to put on some of these neat trades in a high volatile market, because debit spreads help neutralize volatility and reduce cost outlay, because during market crashes or periods of high market volatility, options tend to increase in price, and because of that, it makes it more expensive to trade, and certainly influences your outcome because you have different risks in terms of volatility, contraction, and other areas. We'll talk about that. And the last one, which I also wanted to spend some time talking about, is the execution of a collar strategy. And a lot of you may own investments in your portfolio, and during the crash, it didn't feel very good when the markets were going down. And now we see today many of these stocks have rebounded a good part of those losses. And though many of you may feel that there's still risks in the markets, and so how can you create ways of hedging those stocks in your portfolio without having to sell them? And so we're going to look forward to kind of taking you through some of the different examples on how we can do that in the market. So let's just though start off and talk about we're going to talk about the different ways that strike prices and expirations work, and this all looks in the live markets. And so, looking forward to taking you through some of these examples. I wanted to just many of you saw when Luke was on doing the introductory to options. We were looking at the impact of time. So we were looking at the more time until the expiration, then the higher the premium. It's got to reflect a bigger probability distribution curve. The time value intrinsically built into an option is about the function of unpredictability. Over a long period of time, stocks have a much wider range of possible outcomes, and therefore an option has to be more expensive to reflect on that. And that uncertainty decreases every day that you approach that expiration. And so, they were demonstrating, like, and Luke was talking about at the start of this whole session, you start to see the different strike price. Sorry, you see the same strike price of $15, but as you go into the future, and you're, let's say, looking at a July option, or a September option, or January of 2021 option, the price of the option is increasing by that. So you'll see that reflected when we look into that live market. The other thing that I want to really be able to illustrate when we start looking at the live market in this segment is we're going to look at the option premium and the way it breaks down between its intrinsic value and time value. Now, again, the way Luke was explaining it earlier is that the time value is the part of the option that you're paying for your right, and that inevitably, as you approach the expiration date, will inevitably reach a zero value. And so the way we can divide in an option that has an intrinsic value what the time value is by minusing the current price from the strike price. I'm going a little quicker because I know Luke already reviewed all of this with you. And so what I'm looking at doing here is going to the live market. So we're going to just illustrate this in a moment. The way that Luke had it broken down was, let's say you had a $15 call option and you had a $20 stock, and the call option, let's say, is trading at $6.50. We have a scenario where $1.50 of that option is time value, and $5 is its intrinsic value. Again, I'm about to show this in the live market, so I want to get through the slides quickly so that we can spend more time in the live markets. In a similar manner, the put option is the same, where we, let's say, have a $5.95 option, but the put option is my right to sell the stock at 25, and the stock is still trading at its $20 price. And so it has a $5 intrinsic value. So 95 cents is that time decaying time value, and the other $5 is its intrinsic value. So let's just dive right into the to the simulators. And what we're going to do is we're going to illustrate how to identify this. How are we going to be able to look at which ones of these options, the moneyness, is it in the money, at the money, out of the money? How do we differentiate these strike prices? How do we account for the amount of time available in the option? And so what you'll see is that they'll divide where the different strike prices are and the different values of the options. And so let's just dive right into this and do an example. So the first thing we want to do is just show everyone where they can download the simulator. So this is the Montreal Exchange website. I'm on the English version of it, m-x.ca. And under the Education tab, you go down here to the Trading Simulator. And when you click on this Trading Simulator button right here, where my mouse is scrolling, you're gonna it's gonna give you your login, and when you log in, you are given and come to a dashboard that looks like this. It's a simulated account, and what I've done here, I've one account here that has already a number of stocks in it, and another VOED one here where we funded an account with $100,000 cash and nothing else in here. And we're going to go into the live markets, and we're going to actually put on some of these different trades real time. So so let's start off by just breaking down an options chain. And so what I want to do is let's just use Barrick Gold for an example. It's been doing incredibly well as gold has been rallying. So I'm going to go under the quote screen here. I already have Barrick Gold already loaded up, but you can type in the symbol of whatever security you want up here. Let's just say that right now I want a TD Bank added here. I would, let's say, go here, click on TD Bank, and you can see it comes down and populates right into this drop down. And so you can see here I have a number of Canadian stocks in here: Suncor, the former TransCanada Pipeline, the TC Energy. I have Royal Bank, Barrick Gold. They're all on here. So I want to focus on Barrick. It's at 38. We're just going to round it and say it's at $38. And what we have here is that if you scroll all the way to the right-hand side, you can see this options chain button, which is the two little squares on top of each other. And what I'm going to do here is I'm going to click on this for Barrick Gold, and it's going to populate the options chain. So what are we looking at here? First of all, I'm going to just look at, I'm going to switch it to all options because I want to actually get all of the strikes captured in here. And then what you can observe here is that they have all of the different expirations along the side here. And so you can observe here that we have the May 1st, which is the weekly option, May 8th, May 15th, May 22nd, June 19th expiration, July 17th expiration, the October, January 2021, and the January 2022. So you can, at this stage, go to Barrick and trade options that are almost 2 years in length going out to January 2022. So what we're going to do is I want to focus, let's say, going about a month and a half out. We're going to go to the June expiration. So I'm going to click the little triangle here, and we're going to populate out the Barrick Gold options chain. And what you can see now is that all of the different strike prices available. So the call options being on the left side, put options being on the right. So you can see calls over here and put options over here, right? And so what we're doing is we're going to look at the strikes, and notice what they have done for us is for the call options, all of the options that are in the money, which have an intrinsic value, you have in dark gray all of the ones that are in the money. To the reciprocal, a put option is in the money when higher strike prices. And so you can see the 40 and 42 and 44 and $46 strikes are all dark gray. And so what you can see is that they've basically color coded the in the money options by them being dark gray, and the options in the very light gray are all of your at or out of the money options. What we know is that with the stock trading at $38.01, that the $38 option is at the money. Because if I buy a call option that gives me the right to buy Barrick at 38 and it's trading at 38, you're at the money. And so what's nice about this simulator is that we can turn around and hit the little details button, and it gives us all of the Greeks. So we can now, I don't think we covered in any of the prior presentations all of the Greek math, so I'm not going to go and confuse anyone. But those of you that are online are a little more sophisticated, the Greeks do appear for you here in the simulator. We can currently identify two things that are relatively worthwhile. Number one is its implied volatility is being priced at $45.89. And so So we have a scenario where we now know that this option at the money is being priced at the 45.89%. And so we can also determine what the Theo price of the option is. By the way, Theo price is the mathematical value of the option. A market maker is going to be putting a bid and ask spread around. So notice here, Barrick is bidding $2.74 on the option, and the $2.85 is the asking price, and the Theo price, the mathematical price of the option, is actually $2.80. And so the spread is the cost, no different than, let's say, the spread on a currency conversion. It's the for providing liquidity, that is the bid and ask that is associated with it. So why I want to now kind of dive into this and ask the question: why would somebody choose to buy an in the money option versus an at the money option versus an out of the money option? And so what I want to do is introduce everyone to a simulator that actually still in beta form. In Big Picture Trading, where I'm from, we're going to be launching this actually about a week from now. And what I want to do is simulate the different choices of strike prices for all of you. And so what we just saw here was that this is priced at a 46% volatility premium out to June. And so what we're going to do is I'm going to put in a $38 stock price, right? So $38. We're going to zero interest rates. By the way, earlier Luke was doing the presentation talking about the 6 variables that go into an options price. In a simulator like this, we can literally compute mathematically the value of an option, long as we know all of the 6 variables of price, strike, time, volatility, dividends, and interest rates. And this is where you can see we can input dividends, we can input interest rates, we can input the 46% volatility premium. And what we can do here is we can build a simulated position. And so what I want to do is compare for all of you the idea of the different strike prices we can buy. So let's quickly here pull up a chart and look at the Barrick Gold chart. And what I want to show all of you is, okay, so it's right now trading at $38, right at the money. And what we'll do is we'll look at it and say, well, what if I bought a $42 call? What if I bought a $38 call? Or what if I bought a $34 call? Actually, let's go a little deeper in the money. Let's say 32 and a 44. I want to just really widen the range from it. And so obviously, we're going to buy the 32, which is in the money, the 38, which is at the money, and or the 44, which is out of the money. And so in the simulator, let's start off by simulating a in the money option. And so what I'm going to do is I'm going to buy a 30. We're going to go a call option. We're going to go long, 1 call option at the 32 strike to the June expiration. And we're going to do this, and we're going to at the same time compare how the option performs relative to buying the stock, 100 shares, because 100 shares of stock represents 1 call option. And so when we calculate this, what we have here is the simulator pops up over here, the simulation. And so what we can observe here is that we have a $38 stock and 100 shares of it, as versus a call option that is a $32 call option that's priced at $6.53. And so what we have is a scenario where we could control the option, this $32 call option, and it costs $6.53. How does that compare to the live market? Well, if we look here, right here, they're pricing in a $32 call at $6.90. So what is the implied here? It's a 63 implied. So this is why we're off a little bit on the pricing. But you can see that it's about 30-40 cents off from the price in the simulation, but it will be sufficient for us to actually accomplish what we're trying to do. What we're trying to do is say, how does this call option, right? So how much did this call option cost? It cost $6.53. And so it costs $652.73 for this position, versus that of an investor who would rather just buy the shares for $3,800, right? So an investor here would buy $3,800. And what I want to simulate in this scenario is how does the investor with the call option compare to how the stock did? Now, before we go through that exercise, I want to test all of you. If you have the right to buy Barrick Gold at $32, and right now it's trading at $38, what's the intrinsic value? $6, exactly. And so, of this $6.53 option, how much is time value? 53 cents. Look at this. Look at all the responses. I love it. All right. So what we have is 53 cents option. So watch what happens. I'm going to grab this time bar, and I'm going to time erode the option to 0. And what I want all of you to see is that the stock is at break even because it's still at $38. But notice the option at its expiration, with 0 days till expiration, is still worth $6. How much actually time decayed? $53 or 53 cents, which is $53 of profit loss. So what happens is only the time component of this option is actually eroding to 0. Now watch also about how much this in the money option, which we didn't cover Greeks, but it's what we call a high delta option. And so let's go back here and simulate a scenario that this stock, that Barrick rallies from $38 to $50 a share. And so let's just say here on the chart, let me just remove these other lines. We right now have bought a call option at 32, which basically gives us at any point a right to buy the stock at $32. What you can observe here is we're going to say, well, what if Barrick Gold rallies by expiration up to $50, and it's up here. And so what we can do at this moment is simulate it going to 50. Notice at this moment that this option that we bought for $6.50 is worth $18. Now, all the speculators in the online from there are saying, oh my God, Patrick, you just made a couple 100% return turning your $6 option to 18. But I actually don't like to look at it that way. You know, I mean, it is certainly a return on risk because we did risk $6 and it did turn into 18. But I want all of you to just ask yourself the question, why is this call option worth $18? Let's go back to the intrinsic value. What price do we have the right to buy the stock at? $32. And it's trading at 50. What is the difference between $32 and 50? $18. This option cannot mathematically be worth less than 18 because that is its intrinsic value. That is actually its worth. If it was trading for anything less than $18, it would give an opportunity for free arbitrage, and some hedge fund would be out there just milking it. That option actually has to be right priced to $18. Notice from a profit loss perspective that this $32 call option, which was up $1,149, was actually made almost the same amount of profit that the investor made on the stock. So what you can see is that the stock investor is up $1,200, and and in this situation, the options trader is up $1,149. This is what when you buy a deep in the money intrinsic valued option, it behaves very much like the stock. It has a value. Now, what if we change this and said, well, Patrick, I want to buy a cheaper option. I want to buy an at the money $38 option. So instead of a 32 in the money, we're going to buy the June $38 call. So when I calculate this, what you can observe here is that that option is being priced at $2.65. And so you have a scenario where instead of now it costing $6.50 for this option, it only costs $2.65. We only have to outlay $265. But this is entirely time value. So you have a scenario in this when we basically erode, let's say Barrick does absolutely nothing till expiration, because that entire $2.65 option is time value, that option has the risk of eroding for a full loss, where the entire $265 option expired. And so so that's where you can see that that's all time value, but it was a smaller capital outlay. There wasn't a risk of $650 if the stock dropped, which you could have lost on the option. This trader was able to limit their risk to $2.65. But notice that if the stock rallied to 50, like in the prior example, notice that this option did not make as much return, only $934, as the in the money one. On a percentage basis, of course, one would look and say, I turned a $2.65 option to now an option that's worth $12. So, so someone looks at it that's looking at it as a percentage return is much happier with this percentage return. But on a dollar for dollar basis, the deep in the money option behaved more like the stock. And this is about the nature of picking the different strike prices. Now, the most speculative one is choosing, for instance, a $44 out of the money option. And so in this situation, let's say I was choosing that $44 call option. Now it's again, I'm buying the call and again with the 44. Now what's happening is that this option is only 81 cents in cost. And so what we have is a scenario where we didn't only had to outlay $80. A lot of speculators love this option because it's cheap. They say, well, I could buy 5, 6, 7 options for the same price that I was paying for that one in the money one. They look at it from the idea that they can control more stock, but there's inherently more risk with this. In fact, in this situation, this particular $44 strike call has is mathematically, if you recall back to Luke's presentation, Luke was explaining to everybody that options were priced upon probabilities, and it's a probability distribution curve. This $44 call, which is giving me over the next month and a half the right to be able to buy in Barrick at $44 a share. This option is being priced for a 75% probability that it's going to expire at no value. Right? So there's a reason this option is inherently cheaper. It's 81 cents because mathematically, what is the probability that Barrick can continue to rally from 38 to 44 and build an intrinsic value above $44 on the option? The probability distribution curve is pricing that in. So while it's cheaper to outlay this 81 cent option, notice here that when we time decay this, let's say towards 0, and let's say it's got 2 days or 1 day before its expiration, if the stock did not rally at all, that then that entire option is going to expire for no value. Notice that that was not the same problem the person who had the deep in the money option had, because they had that $6 intrinsic value inherently built in. But now this is more speculative in nature, because notice that even if the stock with 2 days before expiration rallied to $43, in other words, a $5 rally in the stock, notice here that that the call option is still losing money. It's still only worth about 26 cents, even though they were right about the direction. They weren't right enough. They need you were looking for this option to build that intrinsic. So the point being here is that the strike price selection is an important exercise of determining what you're trying to achieve. What is your objective in the trade? How much time do you need? So notice here, let's look at it from this perspective of how much the different time costs. And so notice here with Barrick, if I wanted to, let's say I want an option that is just going to expire in 4 days. It expires on Friday on May 1st. It costs you $1 to buy a call option at the money at 38. So for 4 days, 4 or 5 days. While if let's say I went out to and looked at it and compared that to, let's say, June, notice a $38 June is $2.85. But this June option has the entire month of May and a half of June still. It's got 6+ weeks of time, yet the option is not 6 times as expensive as the at the money. Time is not an arithmetic exercise in options trading. So notice here as well, if I, let's say, go to October and I'm going, let's say, half a year out, notice that an at the money $38 call is $4.55. Right? And notice that even though this was a $2.85 option is going 6 weeks out, to pretty much go almost a half a year out, it only costs a couple more dollars. So there's this relationship where a lot of the greatest uncertainty is on the shorter time frame, which creates the volatility, the daily volatile range of an option of a stock. Makes the options on the front month much more expensive on a relative basis. And so this is where you have to go as a trader through the exercise of saying, well, if I'm bullish Barrick Gold and I think it's going to go higher, and rather than buying the shares, I want to determine whether or not I want to express that trade through a call option. The question then becomes, how much time do I need, and what strike price would be the most appropriate for the strategy that I'm seeking? All right. Now, I could honestly do this for 3-4 hours, but I'm limited to actually the 50 minutes. So I want to cover doing spread trading, and so I want to discuss why debit spreads are incredibly valuable, particularly in a period where volatility is very high, right? So today we see volatility that is still 2-3 times higher than where it was back in January, because when the market crashed back in March, the market became far more volatile. The daily ranges became much wider, and therefore it becomes more expensive to be able to actually buy an option more. And the second risk, though, associated with that is if you buy an expensive option and volatility continues to decline, you actually in more advanced trading, we call that a vega contraction. It's the period where volatility contraction is causing your option to be worth less. One of the most valuable strategies for hedging that risk is opening your trade as a debit spread versus that of just buying a call or just buying a put. And so what is a spread and how does it work? Now, by the way, buying a call and buying a put for all of our Canadian listeners can be easily done in a registered account or a TFSA, but spread trading is something that's limited to margin accounts. And so you would have to get your account, you'd have to have a margin account open for this. What this involves is the purchase of one option and the sale of another option to create a spread. The difference between the two strike prices is the spread. And so I'm going to explain how this works. But the key takeaway is this, is that by selling a call against a long call, it doesn't require any additional margin. What it means is that the short option offsets the cost of the trade. So it reduces your break even. It reduces your potential loss, and but this comes at the expense of losing some of the upside potential if there's a big outlier move. And so, so we want to just have a look and see, obviously, which one of these strike prices and how you would open one of these. So why use these debit spreads? Again, in periods of high implied volatility, an option can be more expensive, and as well, options on very high-priced stocks. You know, if you're trading the Spotifys of the world, you're going to find that the options are very expensive. So for a smaller account trader that wants to allocate a much smaller capital outlay, can open a spread and with a much smaller amount of capital outlay. So we're going to demonstrate two spreads. We're going to open a bull call spread, and we're going to open a bear put spread. Obviously, bull and bear, many of you are familiar with these terms. When we open a bull call spread, the spread, it comes at a debit, and subsequently will be profitable if we're right about the security going higher. As well, we can, a bear put spread is a spread that's done in anticipation that the market will go lower, and you're making a forecast to do that. So let's actually do a bunch of live trades on this. Let's actually get some of these into the simulator and take a look at this. So let's use an example of, let's say, Suncor. And so Suncor is trading at $21.86, one of the large fully integrated oil companies in Canada. And obviously, this stock went through quite a drop, right? So when you look at what happened, Suncor was a $45 stock. During the March market crash, we saw a decline of 68%, a $31 drop from top to bottom, and it's been slowly recovering. Now, we just saw negative oil prices, and the stock never really badly got hammered. And some traders might turn around and say, well, a stock that doesn't get hammered on negative oil prices is probably close to a bottom. So let's just pretend. Remember, this is not advice. This is just we're creating a scenario. Let's say the investor believes it's not unreasonable for Suncor to trade back to like $26 to $32, and that somehow the potential for this stock to get back into this range was reasonable. And more importantly, you believe that a move up into this zone can easily happen between now and the summer. And so we're going to choose to execute this trade on Suncor through a bull call spread. And so what we're going to do here is we're going to go Suncor. We're going to look at the options chain. So again, notice the selection. We can either go to June or September. So why don't we go through the exercise together and determine whether we prefer to narrow this opportunity to just the next 6 weeks, or whether there's value for us extending it, another 3 months all the way out to like September. And so if you notice here to June, we were looking at, remember, we're looking on the left-hand side, right? Because the call options are on the left and the puts are on the right. We'll look at puts in a moment. But let's just say at this stage, we're looking for a call spread to the upside. And so let's just say we wanted to do a bull call spread between $26 to $30. So notice this option is 45 cents, right? So we could buy a $45 call option at 26, and we can offset that with a $30 put option that is bidding 12 cents. And so let's say you're able to put in your limit order, and our objective is to be filled at 30-cent debit, which is net of the splitting the spreads. We want to buy at 45, sell, let's say, at 15, and we want to be filled 30 cents. So we can open a 30-cent spread that essentially can be worth what? Remember, what's the spread between $26 and $30? $4. That's right. Great. Between 26 and 30, it's $4. And so we're paying, our goal is to pay 30 cents for a spread that, if Suncor between now and June rallied to $30, would be worth $4, right? And you can do the math on a percentage rate of return for 30 cents into turning into $4. It's a 10 bagger, right? And now, what would it be on that same spread for us to do this to September? Because June means that we have to pretty much be right away. I mean, that rally has to start in the next month. Otherwise, if we're wrong on our timing, that entire 30-cent spread may actually expire. Which I mean, by the way, it's a debit spread, so it can't you can't lose more than the 30 cents, but it could expire. So let's go to September and look at the same spread. So notice here, we could buy the $26 call for $1.31. At the same time, the $30 call pays us close to 50 cents. Let's just round it, $1.30 to 50 cents. Let's say that's your average rate. It would cost us 80 cents to open the same $4 spread. But what is the fundamental difference? One expires here in June. The other expires out here in September. And so we're paying 80 cents instead of 30 cents, but the one expires here, and the other one gives us all the way to September to actually be right about Suncor making it into that zone. Everyone following along in terms of which expiration? So let's actually place these trades. And so what we're going to do is we're going to come into the simulator. I'm going to go back to the dashboard. And so we have a $100,000 simulated trading account. I'm going to hit the trade button up at the top. Everyone see that up here? And by the way, it's free to open up the simulator. It's slightly delayed quotes, but it is coming from, the quotes are coming from the live market. So you're able to more or less get the practice. A lot of people find it intimidating some traders find it intimidating to get their first trade on. And so a lot of times coming in here and placing the trades in the simulator allows you to get a lot of over that anxiety of placing your first options trade. So notice here I'm going to scroll down to a bull call spread for Suncor. And so I'm going to come in here and hit go. By the way, I'm realizing I've only like 10, 15 minutes and I wanted to show a caller. So I'm going to make sure I'm going to be efficient about this. They color green and red so that they know which one you're buying and selling. So what I want, so the top one is our buy. And so what we're doing is we're going to, let's say, demonstrate the September $26 call. And notice that we're buying to open this because we're buying the option just the same way we would be buying. We'll just do one contract. And at the same time out to September, we're going to sell the $30 strike call. And that one is selling to open for income. Now, just to demonstrate the fill price, because I would recommend in this circumstance that everyone puts in a limit order to actually be filled, but I want to just demonstrate it being filled. And what you want to observe is that at the prevailing market price, I would be filled at 83 cents or $83 for the spread. That if Suncor was to rally, let's just say comes down, hits the double bottom, rallies, and boom, it's up here at 30 some odd dollars come August. Let's just say, I'm just making up a scenario. So if we had a scenario like this $83 spread can be worth $4 or $400 at its expiration. And so, and no matter what, we can't possibly be risking more than the $83 we outlaid. So I'm going to just submit this trade. They charge a $9 commission in here. Let's go to the dashboard and actually take a look at this trade. So you can observe here under my positions, I now have a 26 by 30 bull call spread open at the 83-cent debit. And so, so again, where did the $400 come from? It's the difference between $26 and $30, right? So 26, 30 minus 26, right, HK, is $4 times the 100 multiplier for options, $400. So we outlaid $83 for something that can be worth $400. Now, if it goes higher than $30, you can't make any more, Gianni, because what you want to think here is that you have said, I'm buying a right to buy the stock at 26, but I have an obligation to sell it to someone at 30. So what happens is that I would exercise my right to buy it at 26, be forced to sell it at 30, and I can make the $4 difference. So with spread trading, you don't have unlimited upside the way you do with stocks and just long call options. What you're doing with a spread is outlaying a smaller amount of capital for a particular part of the market return. Right? So now quickly, I want to put on a put spread. And then, so let's just say we were doing the XIU, right? So this is the Canadian TSX. Let's say you believe that this is a bear market and you suspect that that the XIU is going to go and double bottom retest, and you believe that it's very reasonable that the XIU will once again be trading in the $20 to $18 range at some point going into the summer, right? I'm building a narrative for a bear put spread. So in this scenario, what we can do here, we'll just look at the quote screen on this XIU. I'm pressed on time here, so we're going to have to be efficient with this. All right, so here's the XIU. Going to hit the options chain. And again, we're going to go into looking at strike price selection. We're going to ask ourselves, how much time? I want to be able to hold the XIU into the summer. And so I think a July is reasonable. So now what we're doing, though, is we're looking on the put side, which is the right side of the options chain. Right? Because we're now looking at put options. We're doing a bear put spread. And so, so with the XIU, we suspect it could drop down to between 20 to let's do it to September, let's say. And we believe that it can drop from $20 down to $18 in this range. So notice a $20 put is $1.15. And an $18 put is 61 cents, right? So it's roughly, more or less 60 cents is going to cost us to open a spread that could be worth $2. So let's actually execute this trade and show this. So I'm going to go back into the trade. And what we're going to do is we're going to look at the XIU, but this time we're going to choose the bear put spread, because we're trying to profit from a directional trade on anticipating that the stock market is going to decline. And so in this situation, I'm going to go and look at the bear put spread here. And what I'm going to do here is I'm going to, let's say, go out to September, and I want to buy the $20 put option oh, actually the sell to open. No, sorry, I'm buying, sorry, the 20 and selling the 18. So notice so here we have the $20 put. We're buying it to open. The $1.15 is the asking price. And we're selling the $18 put. We're selling to open for at the bid to 61. So I want to be filled. So I'm going to do it at the market price, but I encourage many of you use a limit order for doing this. What you can observe here, it would cost me $54 or 54 cents on a $5 spread. Oh, sorry, $2 spread. So think of it this way: we're going to pay $54 or 54 cents per share for a spread that could come in at a $2 value, right? So you can make almost 3 times the return, as you can make almost $150 profit on this. And so in this scenario, I'm just going to hit this order and get filled. I'm going to get filled on the spread. I'm going to quickly go to the dashboard. And by the way, each broker, all of you are welcome to choose which broker you want, has a way of executing the trade. And so in each of these scenarios, you see the bear put spread right here. You can see we have this trade. To close this trade, I would literally just, in this simulator, quickly just place the order to thing. The last position that I wanted to just very quickly cover super fast is an idea of creating a collar around your position. And so the collar is basically the idea of hedge wrapping a covered call and a protective put around the stock position. And so what I wanted to do, I'm very short on time, so what I want to do is just actually execute this strategy for all of you with a real example. And any of you that want to obviously learn more about how to execute this stuff, there's all sorts of amazing content that we have on the websites to doing this. So what I want to do is just say, let's say you originally had this position of let's just stick with Barrick Gold for a moment. It could be Royal Bank. You had this position and you now physically are owning the shares. The most important here, everything we did up to now is the idea of just buying an option. But what I want to now illustrate is the idea of we physically own the shares. Notice I have 1,000 shares of Barrick Gold. All of you have positions in your existing investment portfolios on there. And so what I want to do is execute a collar around Barrick. And so what I want to do here is I'm going to look at the quote screen and actually show what a Barrick collar could look like. And so let's just say what I wanted to do on Barrick is create a scenario where let's say buy a $34 protective put, and I'm going to sell a $44 covered call. And what I'm doing is creating a scenario where I've removed all risk below 34 and have all the upside above, and I have all the upside above 44. So in this scenario, what I want to show you is that we're creating a scenario is where we've created all the further upside up to $44 on our physical shares, but removed all risk of loss below 34. Now, this is important. A lot of people are nervous that a market crash can wipe things out and create one of those liquidity events on the downside. And what a collar does is at least it defines the parameters of where your maximum gain and maximum loss can be. So let's just quickly do an example of on these 1,000 Barrick Gold position. And so what let's say I'm going to do is I'm going to let's say we're going to go out to June. And what I'm going to do is I'm going to sell a covered call at $44 for 86 cents. And so what I'm going to do here is literally I'm just going to go one leg at a time. This is the same as covered call writing. I'm going to sell to open. Because I physically own 1,000 shares of Barrick, I'm selling 10 of these covered calls. and I'm going to sell it at the 86-cent bid because I'm out of time. I'm just going to quickly collect. I am receiving $860 income, $850 after commission. So I'm going to make $850 income that's credited to my account as income immediately for an obligation that I have to potentially sell my Barrick Gold shares at 44 when they're currently trading at 37.80. At the same time, what I want to also do is I'm going to buy that protective put. And so in this scenario, I'm going to turn around on the existing share position, and I'm going to turn around and I'm going to, let's say, go out to that June strike. And what I'm going to do is I'm going to buy this $34 strike put. Now, this put option is now bought as protection, removes all risk of loss below 34, because I am guaranteed to be able to sell my Barrick stocks at $34 a share, no matter what, between now and then. So this is going to come at a $1,400 cost. But how much did I earn in income on the covered call? $850. So what I've created is a scenario where for $550 cost, I was now able to create a scenario. As you can see, now it's in this trading portfolio. I have this 34 to 44 hedge wrap around my Barrick shares, 1,000 shares, and the 10 contract hedge wrap. And so what I've created is a scenario where I have all of the upside on Barrick up to 44 and all the downside risk down to 34. And there's absolutely no way that I'm going to lose anything less than 34, but I have also cut off the upside at 44. And I've created a wrap. The simple way to think of this is I've created a scenario where all of my physical shares are wrapped into this hedge wrap. Think of the name hedge wrap, collar. I've created a scenario where if Barrick Gold turns around and comes crashing lower and suddenly is trading down over here, it doesn't matter that it's at 18, because I'm guaranteed to be able to sell it at 34. The point being here is that we've created all sorts of certainties. I didn't have enough time to be able to go, and I was planning on simulating all of this for you and doing all sorts of amazing stuff. But this is what I do full time at Big Picture Trading. I basically go through with my members, and I go through that. Many of you saw already Luke come on, who's my teammate on this. We go in there and we do all these trades. We simulate it. We have all sorts of amazing stuff. I'm going to, over the next a week or two on that simulator, going to be doing all sorts of amazing things during the free trial. So any of you that want to access Big Picture Trading's free trial, it's free, no strings attached. You'll watch me doing this live in the real markets with all sorts of examples. I just put in the link right there to where to register for the free trial. It's in your chat message there. Otherwise, you can just visit bigpicturetrading.com. And otherwise, yeah, I ran over my time. Sorry, everyone, that I was saying, but this is, if you enjoying this, I do this with, like 10 times over with all sorts of amazing strategies. Thank you so much for your time. Thank you to the MX. Thank you, Tony, for hosting all of this. And I'm going to pass it back to you here, JP.